3 seconds to go for the markets to open up. Will we have another opening in the green? The first tick on the Nifty is in the red, but it's a flat start, you would say. The Nifty is down 15 points, the Sensex lower by 75 odd points. There is some pressure which is visible in the HDFC twin. So HDFC Limited, HDFC Bank has opened up on the back foot today. Straight away, you are seeing a knock of close to about 2%. Other notable losers include Eicher Motors. So after the 6-7% fall that we had yesterday, this morning Eicher Motors has opened up in the red. Britannia, ITC too, correcting a tad bit. In terms of the banking updates, IndusInd Bank has been given a thumbs up. The numbers look good, and IndusInd Bank has opened in the green with a gain of close to about 1%. And the other notable one in the banking side is Bandhan Bank. Not a Nifty, not a large cap, but Bandhan Bank is down close to about 4% in trade. ICICI Bank is holding up quite smartly. A couple of IT names are seeing buying. So follow-on buying from yesterday for Tech Mahindra, Infosys, HCL Tech currently up close to about 0.5%. But the index is still pretty flat, just a very, very minor downtick of about 30 points. So after 6 days of gains, this morning, markets have taken a bit of a breather. The mid-cap index, too, in the green, but flat. Well, that's right. Let's look at the big deal as well that was announced late last evening between Syngene and Strides. Syngene, well, the street has read that positively. The stock is up close to 1.5%. On the flip side, you have Strides. That's down close to around 3%. But keep in mind, in the run-up to this deal, the stock was up more than 10% in this week itself. So it's pulling back some part of that. Emphasis as well is down close to around 3%. Dixon Technologies, Jefferies has gone ahead and they've downgraded the stock because of valuation concerns and also because of the composition of their revenue mix. More than 75% comes in from the OEM segment. So that's why they have highlighted those factors. And valuation-wise, it's trading at around 60 times odd. In terms of stocks that are doing well, Karnataka Bank, well, that one continues to move up. It's up 2%. And you have LIC Housing Finance, that's up close to 3.8%. Prashant.
Okay, well, it's a bit of a breather. 20 points lower, 19,375 is what we have. And things are looking a little slower, not a big gap up of, 90, 100 points like what we're used to over the last many sessions. Okay, Motherson is up 5.5% as we pointed out. Genus continues to be on a tear. We just had the management with us, 8.5% on that one. Paytm is coming up, some of these names, Paytm is coming up with about a 3% move, large volumes. LIC Housing Finance is another one, which is coming up with 3.5% gain. IndusInd is higher. Something called HPL, not HBL, but HPL, 5.5%, but huge volumes in this one. Don't usually see this up, on this list right at the start. Apollo, Colgate-Palmolive starts about 1.5% higher. Rallis India is up about 3.5% or so. Market breadth is very comfortably in the green. 3:1 in favor of advances at this point. The losers are HDFC Bank, HDFC, Bandhan. Eicher was down 6% yesterday. It's down another 1.25% or so. AU Bank is lower. And of course, Dixon, the Jefferies downgrade, 2% lower, 42.73. Strides is down 4%. Emphasis is down about 2.6%. So lots of names, actually. Loda, Macrotech, is down about 3% as well. So market already coming back to being in the flat zone, but this is just the start, the first 2 or 3 minutes of trade. Rahul Arora is Chief Executive Officer at Nirmal Bang Institutional Equities. He's with us here in our studios. Rahul, great to have you with us here. Thanks very much for your time. We get a moment to catch a breath. I mean, corrections are also they just last 30, 40 minutes, like what we saw yesterday, right? We started higher. By 10 o'clock, we were at the day's low at about 19,300 and then spent the day moving up once again. What's the sense? Is it getting a little too fast for everyone's comfort?
So, morning, Prashant. Thank you for having me on the show. So, just I'd reference back to the conversation we had about a month back when I was on the show. I think because the Nifty has spent such a long time in that range of 16,700 to 18,700, I was of the view then that if it broke out, it probably head to 20,000 before we know it. I think it's more a technical factor than anything else. Obviously, you're a beneficiary of flows. I don't think incrementally any data points have turned positive. I think what was positive a month back holds today. Your rupee is stable. The external sector is fine. Crude is still between 70 and 80. So all of that is known. I was hearing Nigel just talk about one of my competitors downgrading a stock because of valuations. That's a concern across the board. I think, it's very difficult to value stocks on FY24. It's becoming very difficult to value stocks on FY25. And part of the reason, Prashant, is, and I don't really fault the buy side, is because whatever liquidity they are getting, they're pretty much buying the same stocks that they already have in their portfolio. So as sell-side analysts, you can do one of two things. You either increase your multiple, or you increase your time horizon, or you do the third thing which sell-side guys love to do, is you do a DCF. So, there is only three ways you can justify when you can't, because you can't increase your earnings beyond a point. So our valuations stretch at this point, for sure they are. Can this leg take it to 20,000? It can, but it'll probably be fueled by liquidity. I think there's still some monies moving away from China. In fact, Prashant, you may have noticed last month was the highest inflows into the US stock market since October last year. So that, and what's shocking me, that this is all happening in a very high interest rate regime. So, I don't know whether people have started discounting rate cuts in 24 or whatever and started moving beyond. But ceteris paribus, I think valuations in the near term are definitely a challenge. I think fixed income over equities from here probably presents a better opportunity.
Rahul, momentum always chases performance, right? And that's what we are seeing across. But what have you made of the provisional updates that we've got from the banking numbers so far? HDFC Bank's advances growth is not that high. For Bandhan Bank, their loan growth is 7%. Their guidance was for a 20% growth. The CASA numbers for many of the banks have fallen, so NIMs could remain under pressure. Have what we've seen so far from the provisional banking updates, does it make you a bit worried?
So I think if you adjust for bill discounting and other factors, I think HDFC Bank's numbers will be about 19-20% on advances. I think the reported is about 15-16%.
13%, I think.
Yeah, so I think Bandhan was a bit of a disappointment because both the advances and the deposits came in high single digits and low double digits. But I think the point here is, as we saw the case of Federal Bank last quarter, for example, because that comes to mind immediately where you saw NIM compression. I think that is probably going to happen for banks over the next couple of quarters, because over the last 6-8 months...
But we've been talking about NIM compression, right? So isn't it priced in already?
No, and to some extent, and I'll tell you why. I think if you look at ICICI Bank's results over the last couple of quarters, they've actually been very good, but the stock's done nothing. So to some extent, I think it's probably priced in. But the point here is, I think when you look at the banking sector as a whole today, you're operating at peak ROA, peak ROE, peak NIMs, peak asset quality, peak credit growth. Everything is peak, right? From here, if you go into a slowdown, I don't know if you're aware, but the outstanding credit card dues in India today are over 2 lakh crores. It's the highest it's ever been. So if you have a slowdown, you're going to have an issue on retail NPAs going forward as well. Corporates are a thing of the past because corporates have delevered. But I don't think banking is going to be the sector from here at a 45,000-46,000 bank Nifty that will lead the market up. I think there are a lot of other sectors around it. That being said, is there a bottom-up approach? I still think there is. I think there is still a trade left in PSU banks from a valuation standpoint, predominantly SBI and Bank of Baroda, which reported their highest ever return on equity in the last quarter. I think their balance sheets are in excellent shape, and neither of them are trading much beyond 1. I think a Bank of Baroda might be at 0.8. So I'd probably be inclined more towards public sectors than as opposed to private sector. But now that we know this new avatar is going to take shape very soon with the HDFC family, I'd probably stick my neck out and buy it. I think you have to keep in mind, Rima, that at this base, if HDFC Bank is still giving you a 15% growth, you take it any day of the week. I think when you reach that size, a Hindustan Lever is struggling to give you that top line growth. Infosys is struggling to give you that kind of growth. So I'm giving you parallels from other sectors. At 2.7 times or 2.6 times, HDFC Bank to me should be a portfolio.
So HDFC Bank, Bank of Baroda, State Bank of India, right? So you're comfortable buying these banks? I
would be. And I think if you want to go down the market cap chain, I think something like a Federal Bank also looks interesting to us.
Well, and that's done very, very well in the last few days as well. That's suddenly come back to life. But we've spoken enough about banks, Rahul, and you don't duck this one in terms of picks from the broader markets as well. Last time you joined us, you told us Westlife, that could easily go to around 2,000 rupees despite the big up move that you're seeing. Power Mech was another stock that you spoke about as well. Could you fill us in with a couple of names that are looking interesting? Maybe not from a near-term horizon, but someone who wants to build a portfolio. A couple of names that you all are looking at.
So let me turn it back to a sector that I'm very passionate about, which is consumer. I think you can look at P&G and Gillette.
Okay.
I think if you look at P&G, we're expecting, and if you look at the last 10 years, I think Procter & Gamble has actually had the best top-line growth of any FMCG stock in India. What has hurt them, of course, is margins. And I think what we are expecting is a 700 basis point margin expansion between 23 and 25. Because, if you look at wax oils and things like that, which go into Vicks and other raw mats for Old Spice, and even if you look at the female hygiene part of it, the main raw material is pulp, which has corrected dramatically. So I think you're probably looking at a 35% earnings compounded in Procter & Gamble, and the valuations, while they'll probably be at 44, 45 times, this is a 100% return on equity, return on capital employed, and ROIC company. Okay. The other point is Gillette. I think the stock is now starting to show some growth. Obviously, the Virat Kohli culture and don't shave was probably prevalent for a very, very long time. But I think if you see the new brand ambassadors that Gillette has gone into with Shubman Gill and Sanju Samson and the like, I think they're trying to send a message with, and the female part of the business as well with Venus, where I think Deepika Padukone was the brand ambassador, is doing really well. In our last interactions, that's growing by over 20%. So I think Gillette has seen almost a 30% correction from its peak. So I think a couple of stocks on the consumer side, because valuations are becoming challenging in that part as well, as I was discussing in banking. Yeah. But I think where we're reasonably comfortable on earnings growth, these two could potentially be very good stocks to be holding on to. Very classy names, very good return ratios, very good cash on the books. You sleep well at night owning P&G and Gillette. So I think those are a couple of names we definitely look at.
Coming back to banks and financials, Bajaj Finance, Rahul, any thoughts on that one?
Buy it. I'm a buyer. I know there's a threat, partly because the promoter entity of your channel is obviously going to be listing its share in the not too distant future. But I mean, look, 30% kind of growth. Again, well, like I was talking about base effect with Rima. It's remarkable. I don't see, I think with consumer durables, the kind of financing that they've done, IDFC First has done a very good job in getting into that. HDFC Bank's also trying to do its best. Obviously, some stocks, Prashant, like a Bajaj Finance or a D-Mart or an Asian Paints, some of these names get so priced to perfection that the margin for error is very, very little. And then you sort of get a 10-15% fall. But the interesting part, Prashant, is that these stocks don't fall too much because, anything that you see as a slight setback also will be seen as a buying opportunity by institutional investors. So I have no problem buying, even a Chola for that matter. I think some of these stocks are expensive for a reason, and there are some stocks that are cheap for a reason. So I think if any opportunity you get to buy into names like Bajaj Finance or Chola, maybe, the erstwhile HDFC, which was obviously now going to HDFC Bank, these would be buys for me at all points in time. So 30% growth on this base is absolutely remarkable.
Rahul, you track the retail, the consumption, the QSR space very closely. What's the feedback on the ground? Channel checks with your conversations with management?
So I think there is definitely a slowdown post-Diwali, and let me explain it to you very simplistically, right? If you take an urban metro tier 1, person who's maybe say making north of 25-30 lakhs of a CTC, right? You probably have a situation where that person spends about 10,000 rupees a week if you go to a decent restaurant or a movie. So that's about 40,000 rupees a month and about 4,80,000 rupees a year. So let's take about 5 lakh rupees a year, and let's say COVID lasted for about 18 months at peak. So that's about 7.5 lakhs worth of savings that you had. The economy well and truly opened up only around April last year. So when people say that what's happening is structural, I question that because I still think a lot of this is revenge or whatever, that savings that's coming in. And my sense is as you approach 2024, you're going to see a bit of a slowdown in consumption going forward because a lot of this, don't forget, Rima, FY22 was a record year for financial services. Buy side, sell side banking, bonuses were anywhere between 50 to 100% on CTC. So consumption got a huge boost, over the last 12 to 18 months. This is not going to be sustainable. You need to be a little wary. You need to find companies in consumption that are going to be sort of beat that. Like I was saying, which are very, very close, where consumers are not going to leave that product. So P&G consumer, if a woman's consuming it, she's not going to leave it. If a guy is consuming Gillette, he's not going to leave it, so on and so forth. On QSRs, like I've said in the past, I think Westlife has done a remarkable job. You look at the 2 years in the build-up to the pandemic period and the 18 months post, it's outperformed on same-store sales growth to any other company, including Jubilant FoodWorks, which is a delivery business. So I still think in the near term, valuations are definitely a concern at 60 times price to earning.
But this slowdown is going to get reflected in the earnings of next...
FY25, I think. FY24
right
will manage.
Right now, we're not at the risk of any earnings downgrade in the upcoming
No, and I'll tell you
season.
why. Because when you say earnings, a lot of this is going to come through EBITDA margin expansion. Right, I think if you look at palm oil prices, crude oil prices, they've all collapsed, right? So whether it's a Lever, Britannia, Godrej, they're all going to give you. Rima, let me put it into perspective. From 2013 to 2023, Lever grew its top line only by 8.8% compounded, but the margins went from 13%, 14% to 25%, and they compounded earnings by 17-18%. That's why the stock went from 300 to 3,000. I think consumption, even going forward over the next 12 to 18 months, is going to be more a margin expansion and earnings story rather than a volume growth story.
Okay, all right. And final question then in terms of autos, we just had the monthly numbers. We've got a couple of big launches as well that are, you're more a car person, the plush cars, the fast cars. But what do you make of the two-wheeler premium biking segment out there? Because that's going to be quite interesting, particularly for me as a consumer, not from a stock market perspective.
No, so I think it's a very interesting question because, you know, the only person who can lose market share is who has it, right?
Yeah.
There was a time Maruti had 100% market share in the auto market. So obviously Eicher is going to face a little bit of heat from Hero. The question is, what does that 93% market share in that segment come down to? Can it come down to 70%? I don't think so, right? I know Hero has its own distribution, but this is going to be a slightly longer term game. When you talk about monthly sales numbers, just look at the last 1 year and you'll get your answer. Eicher has outperformed everyone else by some margin. In fact, even for the last month, while everyone was struggling, Eicher grew 20%. So if you actually did not have Hero launching the Harley, bike yesterday, there's a good chance that Eicher would have been up 4-5% yesterday because of the strong auto numbers. Yes. So I don't see it as too much of a threat. I think it's a 27% return on capital employed company, almost a 21% return on equity. The good thing in the Hero's favor, Nigel, is that it's a 5% dividend yield company by FY25. Yeah. So, you know, that is a very, very big factor when we're forecasting our numbers. But I don't think there's too much of a difference on the return ratios. But I think the growth that Eicher will show will in FY24 be double of what Hero will show. I think Hero will probably give you a 12% top line growth. Eicher will be 24%. So I'm still comfortable paying the valuations. I think you probably use yesterday's correction to buy into the stock. If I was to own something in the mass market, I'd play Hero. But in premium, if I was to buy only one stock in two-wheelers, it would definitely be Eicher.
Oh, good thought. You know, when we were growing up, Rahul, when we were dreaming about riding a big bike, there was just one. The youngsters today are lucky. You know, they'll have 3, 4 in the next few months. So
you're young enough yourself, Nigel.
All right. Thanks so much for that.
Pleasure. Thank you for having me.
In fact, let's take this auto discussion forward. Hero MotoCorp and Bajaj Auto are betting big on the premium motorcycle segment. Hero Motor, together with Harley, announced the launch of X440, and Bajaj Auto today will be launching the 400cc Triumph motorcycle. Does this heat up competition, especially for Eicher Motors? We have with us Basudev Banerjee of ICICI Securities, Rohit Paradkar, Senior Assistant Editor at Overdrive, and Jay Kale of Elara Capital. Gentlemen, thank you very much for joining in. Let's first talk about Eicher Motors. You know, Basudev and Jay, and we'd like your comments on it. Rahul just told us the only person at risk in this is the person who has the market share, and that's Eicher with a near 90% market share in the premium motorcycle segment. Yesterday, the stock price fell, but Rahul said he's comfortable buying it at current levels. Basudev, your thoughts on Eicher Motors as things currently stand?
Yeah, so the very point what you mentioned, that the only person, the company who can face risk is who has the market share. But if you look at examples, say in the SUV space, where so many launches happened in the segments like Creta or Seltos got created in last 6-8 years. They were hardly existing in the market. So today, if you look at within the bike market, 350cc plus segment contribute hardly 7% of the market against 14-15% in other developing markets. So the scope for the market to expand itself is there, which will in case absorb the supply from new quality OEMs like a Triumph or a Harley. And one more important aspect, if you look at, is in last 5 years, where total cost of ownership of a premium bike has increased by almost 40%, with the same classic, which on-road price being from 1,80,000 up to 2,30,000. But the demand has only increased and the percentage mix in the bike market has increased. Now, finally, when there are no more such inflationary pressures on the TCO for a premium bike, I won't be surprised if the market itself expands and absorbs this new supply. Yes, Eicher Motors market share being at 90% plus definitely should be under pressure, but anybody at 90% market share can't sustain at those levels for a prolonged period. And that is very much, I suppose, factored in the price per se.
Got that. Jay, would you broadly sort of agree with that assessment that the guy with 90% has got the most to lose? But how does that translate into a view on the stock, Jay, in your opinion?
Yeah, Sarina, I mean, you will see, like Basu said, that of course there will be some bit of market expansion consumers have more options now, versus largely one option. Now they probably will have three credible options going forward. So definitely market expansion is something that will happen. But one also needs to see that, we've seen a lot of price increases that we've for this segment as well as the overall two-wheeler segment. And RE being one of kind of 90% market share, it had the leeway of taking those price increases. But now with the extremely kind of competitive pricing from Harley, and we need to see what Bajaj comes in. The competition is definitely heated up over here, and that could, to a certain extent, restrict RE's ability to take price hikes going forward as well. And also, of course, at current prices, definitely, the stock has corrected, but valuations are still not cheap if we have to speak about Eicher. And with market share coming in, with pricing ability probably being not as strong as what it was earlier with these launches, there could still be some downside left. So currently, we have a sell rating on Eicher.
Rohit Paradkar of Overdrive is also with us. Rohit had a chance to look at the Harley and the Triumph bike as yet.
Not the Triumph one. The Triumph will happen
That's going to be today.
We are,
1 o'clock.
Yes, we are waiting for that. A little while from now, it should be out.
Okay. But you did have a feel from it when it launched in London last week, right?
Sort of, yes. So I think, I'll go with what everyone's saying here. And that's absolutely right that there are now more options, in the segment. And more options are not always good. But this time around, it's going to be extremely nice because the market has matured now. And these options are exactly what, the market wanted.
So thoughts on Hero? Pricing looks attractive. The specifications, look pretty good. How do you see this premium motorcycle segment playing out from here on?
See, I think it's going to be very interesting because, there are two approaches that we've seen in the past, right? We've seen Yazdi, Java, Honda all trying to break that Royal Enfield barrier. And no one's really been able to worry Royal Enfield so much. Even today, like you said, they are enjoying a 90% share. But now with Harley and Triumph coming in, things are going to get very interesting because, typically people aspire to upgrade from a Royal Enfield to a Harley Davidson or a Triumph motorcycle. There are other brands as well, but these two, obviously. And now with these two brands entering Royal Enfield space, and that too at tempting price tags. And again, finance is also pretty easy to get these days. So customers are definitely going to have options. They're also going to have the spending capacity. And, these vehicles look very good, not just in terms of the way they appear, but also on the spec sheet. So it's going to be very interesting here on because Harley and Triumph are two very big brands that are entering this segment. And probably they will have a better chance than what Yazdi, Java or Honda have had in the past.
No, got that. In terms of pricing, if I can sort of ask you, and we will, of course, know today afternoon, Rohit, do you think Bajaj will find it harder to price their product above, what Hero has done for Harley? So,
I'm sure it's going to come at a premium. I'm definitely sure it's going to come at a premium. I don't think, they will be able to price it neck to neck with a Harley Davidson, the X440 that we've seen. I think it's going to be more because the equipment that we've seen on that vehicle, the kind of tires they're using, the suspension, even the overall quality, the fit and finish, it all seems to point in the direction of a more premium price tag. So I am sure that they are going to go a little closer to the KTM 390s in terms of their pricing, because even in terms of the specs and the performance, they are sort of targeting that segment. And it's only the design or the appearance where they are going with that modern retro approach that Royal Enfield has been known for all these years. So they are trying to hit that midway point where they are giving you KTM performance and Royal Enfield kind of modern retro designs. So I'm guessing the price also is going to be in between. It's not going to be as low as a Royal Enfield or even, for that matter, the Harley Davidson X440, but it is going to go more towards the KTM 390s. That's my estimate.
Basudev, getting back to the auto sales numbers, what, according to you, what was the reason for Hero MotoCorp's dismal performance? Auto sales numbers down 10%, volumes in the month of June. What's hurting them? And do you anticipate a recovery?
So if you look at the retail numbers, more or less, this is the last month of marriage season. And more or less, nobody will be willing to pile up inventory at this juncture. especially with festive season being in late October this year, unlike early October or late September in previous year. So that's why I suppose post July, your wholesales will start looking good as a precursor to festive season inventory getting added in the system. But if you look at the retail numbers, they were pretty much normal. So nothing much to take merely from the wholesale numbers as such.
Okay. All right, gentlemen. Thanks so much for joining in and giving us your view on this exciting premium bike segment. Let's see how that shapes up. For the time being, though, let's shift focus. Godrej Properties, that's a stock on our radar. My colleague Sonal Butra spoke to Gaurav Pandey, the Managing Director and Chief Executive Officer of Godrej Properties, in his first ever TV interview after taking over as MD and CEO. She began by asking him about the land acquisition spree in Gurugram as well as Kolkata and the company's business development pipeline. Let's listen in to what he had to tell Sonal.
Godrej Properties, as you rightly said, is in a very exciting stage where we're looking at investment opportunities across key geographies where we operate. Last financial year, we did close to about 18 transactions. Our guidance to the market was adding 15,000 crores worth of booking value locked in projects. And we did close to about 32,000 crores worth of booking value locked in through 18 transactions. And we're very confident that this will fuel the kind of profitable growth that we are envisioning for ourselves. And we're continuing that momentum, but selectively in areas where we believe there is very strong demand. And we are seeing consistent great sales momentum, reducing our inventory in those markets. And the recent ones, you're right, there are two transactions, quarter one we've done, which we've kind of already announced. One is in Kolkata, a very prime micro market of Kolkata, New Alipur, close to about 7.44 acres of a transaction, leading to about 1,200 crores of potential top line. And the transaction, which is in Gurgaon. So very excited on the growth momentum we set ourselves for.
Okay, so the 15,000 crore rupees of development value that you've guided for, do you think, first of all, how much of that have you done in quarter one already? And do you think last year, there is a possibility of exceeding that as well?
So essentially the way we are driven by business development opportunities is out of market, what kind of opportunity you get to see in market. While we have given a guidance of about 15,000 crores, but our efforts are not necessarily targeting to necessarily either get that or even exceed that. We are driven by what kind of underwriting assumptions we are very confident upon and what kind of pricing we are getting from a land market point of view. So at the moment, it looks very bright for us. We've identified certain micro markets in India where we want to deepen our presence or get into within the 4 key geographies where we operate. So within that, reasonably confident that our trajectory will continue.
Okay, all right. So I'll come back to that in just a bit. But when you spoke about land acquisition, at least in FY23, Godrej Properties was one company which saw the highest land acquisition, at least in the organized space. And this is coming at a time when, 2021, 2020, where companies spoke of an asset-light model. What is the strategy here right now? And in terms of pricing as well, how does it differ pre-COVID versus now when it comes to land acquisition?
See, if you take a step back and see overall, real estate market, because land buying decisions are, kind of guided by what you see as opportunities to create impact in the real estate cycle where you operate. So pre-COVID, largely for about 10 to 12 years, we were operating in a very bearish real estate market, and which is a very typical of cyclical market that real estate does see. Post-COVID, we saw the first stage of growth to another 10 years of our upcycle. And we're at a very early stage right now, and we see that there is good pricing we're able to kind of achieve in terms of projects that we are selling in the geographies we operate, which has led to a sort of a very focused approach on what kind of investment opportunities we would like to funnel and kind of accentuate our growth both through profitability and booking value. Now, coming to your question on the structure of the transaction and asset light versus outright transactions, we are frankly not governed by the structure construct right now. What we are guided by is the principles of return thresholds that we want to secure for ourselves. And in certain sensitivity analysis we run, what kind of pricing and margins we'll be able to achieve even in different kinds of market scenarios. We are seeing currently, coincidentally, those transactions happen to be outright. That is frankly demonstrating out of our conscious strategy to outright only. We have a good pipeline of even JD projects. It is just that we did a couple of bid participations and we won those bid participations which were led by government itself. And we saw great projects in certain geographies where landowners were keen to do it through an outright transaction, which has led to the kind of growth. And fortunately, because of this and being at the start of an upcycle, our ability to command better margins because our economic interest in each of these projects happens to be larger, we will have a potential upside coming from it. But honestly, it was not driven out of construct to do only outright. It's just pure market opportunities and what we can create as win-win for ourselves and landowners.
Okay, that makes sense, and that explains a lot as well, because land acquisition is something that is very specific to the cycle that you're in as well. Take that point. Gaurav, let's talk about cash flows, because Q4 was really good for your cash flows, record high there. But I was looking at the quarterly trend. Operating cash flows have been around 20 to 22% of the total cash flows. Now that surged to 50% in Q4. First, what led to that? What is the cash flow cycle looking like? And whatever capex that you have in place coming ahead as well, will it be funded via internal accruals? Will you be taking more debt for that? What is the plan there?
See, essentially, if you see, our business has elements of cash inflow planned from 2-3 variables. One is your ability to launch a project on time. Then you construct a project, you get to see if you sell a particular phase by about 60% plus within a launch. And if you have right kind of payment plans, largely when a project is about 60 to 70% plus of construction, you start hitting operating cash flow positive. That's the typical thumb rule. Of course, there are projects where it tends to be a little faster and some exceptions even from a later point of view. And most of it, if you see why it happened on Q4, is because we had very heavy OC calendar in Q4 of previous financial year. So of course, when your operating cash flows are governed by your COC or cost of construction is covered, you're enjoying that surplus operating cash flows in Q4. That's typical of the nature of business we have. It is more lumpy towards H2. So, and from a pure cash flow planning point of view, we are largely looking at it from an internal accruals and a combination of projects which we have launched earlier in a couple of years back, which have driven OC, and some phases are left. We're completing those and we're getting good surplus cash flow. And we are very confident and positive that this year will continue to be a very exciting year for us. In fact, if you notice, Godrej Properties last year delivered close to about 8,900 crores and 90 crores of sort of a collections number, which is higher than the booking value number of the previous financial year, which is a very interesting aberration, purely reflecting from great collections efficiency and faster construction completion, giving us those kind of collections and therefore positive operating cash flows.
Okay, and it is important for real estate companies, right? The collections that you get, the cash flows as well, because that is very important for investors to track as well. A couple of more macro level questions that I wanted to understand from you, because you are a market leader. What is the pricing scenario right now? We've seen that there is a pause in interest rates, so to say, but do you think you will be able to push price hikes further, or the price hikes that have happened in the last 2 to 3 years will consolidate at these levels?
See, again, pricing, if you see, is very characteristic of different micro markets in the cities we operate. So if you see in the last 2 odd years, NCR has been leading the price appreciation chart for us and for most developers operating out of that market. And there is a good continued trend. We are seeing sort of a secular trend in the micro markets of other geographies, but not to the accelerated level that we have witnessed in the north market, so as to speak. So first, there is a reasonable probability to say that given there is such a strong demand for end user driven products in good micro markets, it's a fair case to assume that there is a reasonable probability that price to some extent will continue to grow. To what extent, it will depend upon, frankly, product, location and timing of the cycle that we operate. But till now, we've been able to demonstrate consistent price increase and consistent sales increase last financial year. So with some cautious optimism, I would say, I think we are at the right cycle where there is some amount of good upsides if market continues what it's presenting as opportunities right now.
Interesting conversation there with Sonal and Godrej Properties. Get into a break. On the other side, we'll talk one of the big movers of the day. That's Motherson Sumi. The stock has surged 8.3% following the acquisition of Honda's subsidiary Yachiyo's four-wheeler business. We'll be joined by the top management of Samvardhan Motherson International on the other side. Welcome back. This is Corporate Radar. The stock of the morning is clearly auto parts maker Samvardhan Motherson, which has surged 8.5% after the company announced it will acquire an 81% stake in Japanese company Yachiyo's four-wheeler business. Yachiyo, remember, is a subsidiary of Honda Motors. To discuss more on this development, we're joined by the company's director, Lakshvaman Sehgal, and the CFO, Kunal Malani, on the show. Gentlemen, thank you very much for joining in and congratulations. Mr. Sehgal, this is a big partnership with Honda where you will be holding 81% stake in Yachiyo's four-wheeler business and Honda will continue to hold on about a 19% stake. Just want to first understand, how much are you going to be paying in? Is there any debt on Yachiyo's books? Because purely when we look at the equity value of the acquired company at $145 million and the revenues of 800 plus million euros, it appears to be that the EV to sales is quite less than 0.2x. So are there any hidden costs? Is there debt on Yachiyo's books?
Look, there will be a net cash position when we take this company over. I'll let Kunal explain the deal transaction to you. But I think at the outset, what's important to understand is that Motherson has been handpicked by Honda-san for this asset. This is a very strategic asset for Honda-san. It has a rich history of development of products. It has leadership in its products such as sunroofs and the fuel tanks that it does. But not only that, in the past, it's also done plastic tailgates. It's assembled full vehicles for Honda-san. So really a company that is very rich in engineering, a company that has a lot of capability and has really also copied the footprint of Honda-san globally, which allows us, Motherson, to bring in a lot more products to Honda-san for their future offerings and also take their existing products such as the sunroofs and the plastic fuel tanks and the capability in the other products to our existing customer base for growth for Yachiyo. Very, very strong R&D company, 3 locations, R&D locations, and a very rich history of bringing products to market with very, very high quality, obviously, expectations from the customer and been very successful at that.
From a transaction structure perspective, we would be buying 81% of Yachiyo's four-wheeler business. This will be for 145 million euro equivalent or 23 billion JPY for 100%. So the 81% would be around about 19 billion JPY or around 117 million euros. From a transaction structure perspective, first, after this announcement that we have done, we will be applying for antitrust approvals. Post that, Honda-san will be making a tender offer. They are already holding 50.4%. They will require to at least get 66.67 or 2/3 of the asset, and then they can take this asset private as per the Japanese regulations. Assuming they are able to take this private, they will then buy the two-wheeler business out of Yachiyo. And then what is remaining is the four-wheeler business, which we will then acquire 81% for, as I said, the 117, 118 million euros from Honda-san. And Honda-san will retain the 19%. Now, as of today, Yachiyo is a net cash balance sheet business, with this being expected to go to Q1 FY25 from a closure perspective. Between now and then, we anticipate the net cash position to remain, maybe even accrete from where it is today. And hence, the enterprise value is likely to be lower than the equity value.
Okay. Just Kunal, to you, what will this acquisition take your overall debt levels to, and what would the net debt to EBITDA levels look like?
Sure. We will be taking debt to acquire this asset. As you would appreciate, the terms are such that the leverage here is not going to be a concern. Even after considering all the announced acquisitions that we have done till date, and which will get consummated over the next, let's say, 6 to 12 months, we still anticipate the aggregate net debt to EBITDA to be less than 2 times by the time this transaction is done as well. So much below our threshold of 2.5 times that our financial policy of 2.5 times.
Kunal, you're saying the net debt to EBITDA would go up to 2x. That's substantially higher because I think you ended FY23 with a net debt to EBITDA 1.4x. I understand it's still below the company's threshold of 2.5x, but it's still a pretty big jump in net debt to EBITDA. Would you be looking to bring it down? And once again, what would the absolute debt number stand at?
I maybe I'm being a little conservative when I'm saying 2x. Hopefully we'll be much below 2x, maybe closer to where we are. There is the SAS acquisition that we had announced a few months back that is expected to close sometime in the next few months, where the exact consideration will be known at that particular point in time. But from where we are, our organic business should anyway be deleveraging. And in spite of some of the organic growth that we have already announced, we do anticipate this to be, less than 2x, possibly maybe closer to where we are only. But yeah, as time comes, we will talk about it because the exact timing of some of these acquisition closure is still in the works. So difficult to have a foresight around it. But as I said, existing business deleveraging, new organic growth, adding aggregate level, certainly below 2x, maybe closer to where we are.
All right, Mr. Sehgal, this will mark SAMIL's entry into a new segment, that's sunroofs as well as fuel tanks, which have a revenue contribution of around 3% each. Now, considering the opportunity to cross-sell, how much can this scale up to in terms of contribution?
Yes, absolutely. I think, our chairman, my father, had set the vision for the company to be, 3CX10, no customer, no country, no component to be more than 10% of our business. Yachiyo fits in there beautifully. It adds the sunroof component, which we're not really there in a meaningful way, and the plastic fuel tank capability that they have, and other fuel tank capabilities for such as hybrids, and of course, hydrogen tanks when they come, they have full capability and engineering expertise to really be able to continue to develop that. Honda-san, as you know, has very high quality requirements. They produce some of the best cars in the world. So if these products are able to satisfy their requirements, we are quite confident that taking these products to our other customers as well, we will get traction. Of course, we're only talking about the four-wheelers here. These products are also to be used in off-road vehicles, commercial vehicles. So really a lot of possibilities really open up for Motherson. And also, only 90% of the share of this goes to Honda-san. 10% is already what the company Yachiyo has been able to break into with the other customers, which again opens the doors more for Motherson products to come in. So really a two-way street. Of course, Honda-san will get access to all of Motherson's technologies and portfolio, and bring Honda-san in a meaningful way to our customer split. And Yachiyo will, of course, add to our product offerings that we can to our existing customers.
Mr. Sehgal, right now you're going to be holding a 81% stake in Yachiyo, while Honda will hold the balance 19%. Is there any kind of, conversation between the two? Any plan to take on Honda's stake of 19%? Do you have a right of first refusal? Have they indicated how long they plan to continue holding on to a minority stake?
Look, we are honored to have this partnership with Honda-san. Of course, they have indicated to us that they are planning to hold on to this 19%. But in the longer term, these are some things to be decided together with them. But I think the very important thing is that they continue to hold that stake, that 19%, even once this transaction is done, because they believe in Mothersun's vision. They believe that Mothersun can bring a lot of product technologies to their offerings globally, and they believe in Mothersun as a partner. So, of course, things down the road, we will continue to assess, discuss with Honda-san, but this partnership will continue regardless of the shareholding. And we believe it's something that we are quite excited about and will open a lot of gates for Mothersun.
All right, Kunal, your vision for 2025 was already laid out. Revenues of close to around $36 billion with 40% ROC and 40% dividend payout. Now, with this acquisition, what will the aggregate revenue look like? Because I think you've done a few more acquisitions as well. So how do things shape up now?
More acquisitions, yes. We've always had a pipeline, as we have mentioned again and again. I think the times are turning favorable for players like us, which have a stronger balance sheet as the rest of the world goes through both operational as well as financial stress. So we are getting more and more traction from our OEMs to be able to offer more and more assets to us, and we look forward to doing more. For sure. From a revenue perspective, if you consider our Route 36 construct, we are at 12.7 today. SAS on a gross revenue will add 5 odd billion. Among the other transactions together with this is another billion. And then the organic growth on top. So maybe we'll be hitting somewhere between 19 to 20 odd billion already if you were to assimilate these transactions today. And then there's more to it. So yes, we're on our way to 36 for sure.
Okay, so on track to achieve $36 billion of revenue by 2025. But you gave us a number of $19 to $20 billion in terms of revenues. Is this the number today, or is this the number which you will achieve by the end of FY24?
By the FY25, we will be closer to the 19 to 20 billion mark. That's the time frame by which these assets will be assimilated pretty much completely. But as I said, between now and March 25, hopefully there are more inorganic and organic growths that we can announce.
Okay, and there'll be more acquisitions, but you will make sure that your net debt to EBITDA stays below 2.5x.
Always. That has been our financial policy, and we will stick to that.
All right, Mr. Sehgal, why have you kept the two-wheeler business outside of the partnership? If you could tell us, give us some kind of rationale for that.
Look, this two-wheeler business of Goshi was never a scope of the transaction. It was always kept aside by Honda-san. We were focused on the four-wheeler business, which was what was the request from Honda-san for us to look at. I think this question is perhaps better asked to them, why they felt that they would like to retain that. But regardless of that, I think, again, our strengths are in the product portfolio that they're offering to the four-wheelers. This is where we can add considerable synergies to it. We can add on more customers and also take these technologies to our existing customers. So, even without the two-wheeler business, this complete thing is extremely exciting for us, opens up a lot of doors, and we're quite excited to close the transaction and deliver a strong growth and ROCE from this business.
Mr. Sehgal, Mr. Malani, thank you very much for joining in. Need to slip into a very short break on that note with the news that markets are still very, very quiet. So the first 1 hour of trade has been practically done, and the Nifty hasn't moved too much, just shy of the 19,400 mark. Mid-caps, though, are holding up quite well with a gain of nearly 0.3%. On the other side, our stocks which are on the move.
Welcome back. Well, the markets are as flat as can be, but the mid-cap index is doing a relative outperformance today, and we have still close to around 2 stocks that are advancing for 1 stock that's declining. But let's talk about some of the big gainers at around 10 a.m. odd. Genius Power, that stock is flying away. They've done a deal with GIC. Surbhi joins us to tell us more about that. Surbhi?
Thanks for that, Nigel. So GIC and Genius Power will together invest $2 billion to build a smart metering solutions platform. Now, in this JV, GIC will hold 74% stake and the Genius will hold the remaining 26% stake. For this platform, specifically, Genius would be the exclusive supplier to the platform, and the platform will bid for smart meter projects in India. Now, additionally, another GIC affiliate is going to invest close to 520 crores in Genius Power for 15% stake through the stock warrants. Now, management joined us earlier and they said that this 520 crores that comes through the preference issue will be used towards the platform, and Genius will become a system integrator in the joint venture while GIC will become and 60 to 70% of the order value that comes from this JV will come to the listed company. So that is why you can see Genius Power is surging in trade today.
Okay, all right. Thanks a lot for that, Surbhi. Well, Ekta joins us to tell us about Strides Pharma as well as Syngene. They're moving in opposite directions post that deal that was announced late last night. Ekta?
Thanks for that. Well, yes, the news is largely positive. While Syngene is going to let go of around 700 odd crores, it is increasing its capacity. Maybe the street is worried about the change in terms of the facility that they will be acquiring from Stelis Biopharma, which is basically an arm of Strides. Now, just the news, they will be basically Stelis, which is the Biopharma CDMO arm of Strides, is going to be selling its Unit 3 multimodal facility for 702 crores or $86 million to Syngene. Now, Syngene is going to acquire the unit on a slump sale basis. The consideration is expected to be settled in cash. Transaction to close in around 90 odd days. Now, for Syngene, maybe the worry is that the facility was initially built to manufacture COVID-19 vaccines. They will be investing an additional 100 crores now. This will be basically to repurpose the facility in order to manufacture monoclonal antibodies and to repurpose and revalidate the plant and help strengthen their position eventually in the CDMO business. So there is this transition period for Syngene which they will have to go through, which we would probably take. There might be a gestation period in order to see the results from this particular plan. Now for Stelis, however, they're getting 700 crores in terms of cash. In Q4, the company had indicated that they are looking at strategic options for the company. The total amount of debt which was paid by the consolidated entity of the group was 720 crores in FY23, and they had indicated that they are confident of reducing the net debt to EBITDA to around 3x versus an exit of around 3.4 times in FY23. So this is probably going to help aid in terms of the total debt reduction. The company, Stelis, will continue to expand via 2 more units that they have, Unit 1 and Unit 2. And Unit 2 is also approved by other regulators such as the US FDA.
Okay, all right, Ekta, thanks a lot for that. Well, time to slip into a short break now. But on the other side, our special segment is the economy. Now we'll get chatting with Mr. S.S. Mundra, the former Deputy Governor at RBI, and Suresh Ganapathy of Macquarie Capital Securities, and also Lakshmi Iyer of Kotak Investment Advisors. They'll be talking about the impact of the HDFC Twins merger on the banking as well as the NBFC sector. Stay with us for that conversation.
Welcome back. Today we got the first merged HDFC numbers, and its advances have grown from 16 lakh crore in March pre-merger to 22.5 lakh crore today post-merger. Now, to support this, HDFC Bank has been aggressively raising deposits over the last few months. This aggression has already had an impact, as you will see, on the cost of funds of other banks. Every single bank that has announced its early numbers this quarter, IndusInd, Federal, RBL, Karur, Bandhan, all of them have reported at least a 2 percentage point drop in their CASA. We don't know the cost of deposits. Only one bank has revealed its cost of deposits. AU Small Finance has said that cost of finance has gone up by 30 basis points to 6.58% in Q1. Remember, this is the quarter when bond yields fell by 40 to 50 basis points. So, what's the overall impact of this merger on the banking sector and the NBFC sector? I have with me Mr. S.S. Mundra, former Deputy Governor, Reserve Bank of India, and of course, 40 years career banker. Suresh Ganpati, Banking Analyst, Macquarie Capital Securities, and Lakshmi Iyer, CEO Investment Advisory of Kotak Investment Advisors. Gentlemen and Lakshmi, thank you very much for joining. Mr. Mundra, first up to you, sir. You expect this war on deposits to be continuing for maybe a year or two because HDFC's loans will start maturing?
Tata, first of all, I think what you mentioned in the beginning, and you talked about the fall in CASA. Now, if CASA has grown, it cannot be on the, pricing power. CASA, if someone CASA has fallen and somewhere it has gained, it will be more on efficiency and service offering rather than on the cost of fund. So let's first, so it means the original premises on which we are beginning to discuss itself is yet to be proved. We'll have to look from that angle.
Actually, I didn't get the cost of deposits. Banks have not revealed it. So I had to go for the nearest proxy. But cost of deposits, AU Small Finance has revealed, and that's gone up 30 basis at a time when market yields fell. That was my limited point.
Of course, the small finance bank, they will not be the comparable. But yes, I would mention it like this, that with this whole merger, of course, this is not something new, and the last 2 years, if you look at it, the Indian banking sector, the merger was the flavor. So we had the SBI, and then we have the mergers, consolidation in public sector bank. All that has been happening. But here, in case of HDFC, I think both on liability side and asset side, they would need to do a lot of course correction and some of the things to comply with the regulation. And obviously, they will have to compete in the market for the deposit. And yes, I agree with you. That would have some impact on the rate of deposit being offered. That is one impact which may happen at the industry level. Other than that, I don't think that the rest of the players in the industry are going to be affected by any other element of this merger.
Okay. Yeah, but cost of raw material is very big, sir. If everyone is going to be paying probably 30 basis more, like AU Small Finance, or maybe 20 basis more.
I don't think that everyone will pay 30 basis points.
Okay. I guess State Bank will not have to pay. Yeah. I guess big banks will not have to pay. But Suresh, what's your outlook? Do you see this deposit pain for banks continuing for some time because of one guy getting terribly aggressive? And also on the asset side, this is a behemoth which will now start giving home loans cheaply because their cost is less than HDFC's cost. So on both sides, Suresh.
Yeah, first on the liability side, couple of clarifications here. Lata, the QOQ dip in CASA has got to do with the seasonal aspect because 4Q sees a huge amount of float in the system. And therefore, if you're comparing 1Q versus 4Q, definitely the numbers will look down for all of them, including HDFC Bank. So there has been actually an absolute decline in CASA, and that could be more due to current accounts. So don't read too much into the QOQ decline in CASA.
Point taken from both of you, yes.
Yeah, and having said that, see, there is definitely going to be enormous pressure on resources, and you're not looking at it for the next 3 months, 6 months perspective, because if the combined entity needs to grow at 18 to 20%, say for the next 4 years, the extent of deposit mobilization also needs to be to that great an extent, 18 to 20%. Now we have seen obviously deposit growth picking up, but that's got to do partially with the 2,000 rupee in a way demonetization. But if I were to adjust for that, HDFC Bank's incremental deposit requirements could almost be 20% from a market share perspective, and SBI has another 20-25%. So almost two banks put together take away 50% of the overall resources in the market. So it will be too naive to assume that there is not going to be any pressure on resource mobilization. There will be continuous pressure for every bank in the system because of this behemoth trying to grow a bit more aggressively. What it means is that it keeps a floor for the rates. Rates are not going to come down. Rates may not go up, but at least they will remain at elevated levels. And the cost of deposit increase has got to do with the fact that banks hiked deposit rates last year, and now the repricing is actually happening with a lag. And you will see happening throughout the course of next 4 quarters. So that's on the liability side, where we see continuous pressure. Just one final point on the asset side. There is going to be enormous competition in the market segment. Know that HDFC Limited was a bit conservative in the way it went about trying to grow its mortgages portfolio. I think home loan portfolio. That is not the case with HDFC Bank. They have, of course, a wider reach, a wider branch network. A bit more they will do in affordable housing. And it really, you really have to see how the system evolves, mainly because of the fact that mortgage is the single most let me put it this way, loan segment which has been growing pretty strong over the course of last 5 years. One bank coming and getting a bit more aggressive with the scale and size of HDFC Bank will definitely have implications for a whole lot of players in the system.
Okay, let me come to the NBFC space, which is why I invited Lakshmi hurriedly. Lakshmi, one big fellow has moved out in the NBFC space. So have funds gotten cheaper for NBFCs and HFCs?
Lata, clearly in the HFC space, we have seen, spread compression. So those AAA rated HFCs and maybe some of the AA plus also, which were raising money at higher than HDFC, obviously because of the fact that one large behemoth supply is not going to be there, are trading at par or maybe even marginally lower. I think that's going to be the par for the course incrementally because of no supply from HDFC as an HFC anymore.
So both NBFCs and HFCs will benefit, you think? I mean, well-rated ones. There is obviously within the NBFC space, largely the mutual funds were the large holders, for example. There, obviously, we've seen some spread compression and the absolute yield levels have come down. So, your psychological impact will definitely be there, but the bigger impact has been on the HFCs. Okay. Mr. Mundra, on that, sir, you think NBFCs now can flex a bit? Or do you think that actually HDFC getting along with HDFC Bank will make life more difficult for HFCs on the asset side?
Okay. Lata, I think we have to look separately whether we are talking about NBFC or HFC. Okay. So HDFC being a pure play HFC, I think that releases some space there. But having said that, my take is like this, that growingly the what they call it, the harmonization of regulation which was happening from RBI between the NBFCs and bank, and particularly for HFCs, because there was a separate release of framework, if you recollect, where the HFCs were given a certain direction, a roadmap within which they have not only to achieve a certain percentage of the loan eligible for calling as housing loan, but within that also individual loans and other loans. So with all that, it was increasingly becoming difficult to maintain the current, say, avatar of these entities. Probably that was also one of the thought behind accelerating this merger. So my take is that while yes, there would be some relief in the market for both NBFCs and HFCs, because if someone is going to market for raising the fund, doesn't matter whether it is a HFC or it is NBFC. That is one part. But second, which I look at it, that this housing finance, market probably there would be more acceleration of co-lending between the banks and the other housing finance companies which are there in the market, because the banks will have pressure now. What Suresh was also talking about on the asset side of the HDFC Bank to accelerate the mortgage, and everyone would not be able to do it from their own books. So probably co-lending, which is already getting momentum, will get the further momentum. That is how I look at it.
Mr. Mundra, very quickly, a bank can't fund land purchase. That space opens up for more NBFCs, you think, more business for them?
I don't think that in itself is going to be a very game changer. And when it comes to that, even NBFCs or HFCs would be really cautious about it.
Okay. Well, actually, I was speaking to someone in L&T Realty, and they have tied up with HDFC Capital Advisors or something. They see that as an area where there will be less competition because HDFC is not there. Suresh, the other big question is, can you really grow a 23 lakh crore balance sheet, liability book at the same pace? Remember State Bank, when it was 22, State Bank was 20 lakh crore like 3-4 years ago before the merger. They could have, they always grew lower than the banking sector. You think HDFC can lead such a large number and still grow 20%?
No, look, I think, Lata, it is definitely a daunting task when it comes to the liabilities front. On the asset side, I think growth should not be a challenge the way the economy is growing. And of course, the fact that the unorganized sector is moving to the organized sector. So the asset side of the balance sheet, there is no concern. Definitely on the liability side, it is a daunting task. Having said that, look, they are opening up 1,500, 2,000 branches every year. Cash transactions are still pretty heavy in the market. So clearly, that's another opportunity. As and when they penetrate deeper into the markets, there is no source of deposits which can come through. They are definitely better in terms of technology. And, if you look at it over the last, we have been tracking this sector for the last several decades, I would say. Over a very long period of time, Lata, the PSU banks lost the market share on loans, but they protected that turf on deposits. Whereas we look at the last 6-7 years data, they have started losing market share on the deposits also. So clearly that is only going to get a bit more accelerated over the course of next 5-6 years. And that gives HDFC Bank a bit more amount of an opportunity. So yes, it's a daunting task, but as I said, with their kind of execution capabilities and track record, they can manage to get that 18-19% deposit growth.
Well, just winding up comments from you, Mr. Mundra, do you think that leading such a large entity for a 20% run can be tough? As well, does it mean that, you can't just be a retail bank when it is such a large bank? Probably corporate will get a bigger look in.
Yes, that I agree. I mean to say is going to be tough, but not impossible. And I think the track record which the entity has shown should give us reasonable comfort that yes, it will be doable. Of course, my sense is for initially a year or two, journey would be little more tough because a lot of adjustment would be needed to be done to also come within the regulatory framework. But then it should smoothen. That is how I look at it. And yes, I agree with you. See, while we say that, okay, see, already with this merger, the housing loan portfolio of HDFC Bank would have become bigger than SBI, which itself had a substantially big housing loan portfolio. So I don't think being a bank and also having the requirement of risk framework, sectoral deployment, sensitive sector, all those things will come into play. So it cannot be just, that you grow only the housing finance or retail. I think they have already started looking at corporate sector in recent past, if I'm not mistaken. Probably they would have a still more intense look in that sector now.
Okay.
And economy is supporting that.
Yes, certainly. Thank you very much, Mr. Mundra, Suresh and Lakshmi. Out of time, but I think the key takeaway is that immediately the next 2 years you are going to see deposits on the uptick, because as the HDFC loans mature, its liabilities mature, they will be replaced by deposits and therefore the pressure will continue. HDFC Bank also has the daunting task of reaching the priority sector 40%, for which they have been given 3 years. So there will be that pressure, but the word from the veteran, SS Mundra, is that given HDFC Bank's track record, that 20% still looks doable. On that optimistic note, wrap up on Bazaar chart. Buster's up next.